there, and welcome to the Property Wealth Podcast. We're so glad you could join us today.
Yeah, it's great to have you here. We're diving into a really interesting topic today, real estate notes, specifically buying mortgage notes.
Right, it's a bit of a different angle on real estate investing that not a lot of people talk about, but it can be a fantastic way to build wealth.
Absolutely. And for those listening who might be wondering what exactly a mortgage note is, it's basically a promise to pay back a loan secured by real estate.
Exactly. So instead of just buying properties, you're actually buying the debt attached to those properties. It's a unique opportunity, right?
For sure. We'll cover the benefits of investing in mortgage notes, how to identify good opportunities, and some pitfalls to watch out for.
Plus, we'll share some real-life experiences and tips that can make a big difference if you're considering this route.
It's all about finding the strategies that work for you, especially as we navigate the complexities of real estate investing.
So whether you're just starting out or looking to diversify your portfolio, there's something here for everyone.
Let's jump right in.
Yeah, let's get into the nitty-gritty of buying mortgage notes.
So, Sarah, when we talk about buying mortgage notes, it really hits home for a lot of folks, especially those over 40.
Absolutely, Mike. I mean, at this stage in life, many people are starting to think more seriously about their retirement plans and how to protect their wealth, right?
Exactly. And with inflation being a big concern lately, it's more important than ever to find strategies that not only preserve wealth, but also potentially generate income.
Right, like a traditional savings account isn't cutting it anymore, People need to look at alternatives that can keep up with or outpace inflation.
Yeah, when you're investing in mortgage notes, you're tapping into a stream of income that can be more stable, especially when you compare it to the unpredictable stock market.
That's a good point. And, many people might not realize that mortgage notes can provide a way to have a consistent cash flow, like monthly payments that can help cover living expenses during retirement.
Exactly. I remember a client of mine, let's call her Lisa. She was around 45 and worried about her retirement savings. She had some money in the stock market, but it was really volatile.
Oh yeah, and that can be nerve-wracking.
For sure. So Lisa learned about mortgage notes and decided to invest in a few. She found a couple of performing notes that paid a decent interest rate.
Nice. And that must have brought her some peace of mind.
It did. She told me how reassuring it felt to have that monthly income coming in, knowing it wasn't reliant solely on the market's ups and downs.
That's such a great example. And it's not just about the cash flow either. It's also about the idea of passing wealth down to family, right?
Absolutely. Many people over 40 start thinking about legacy, what they're leaving behind for their kids or grandkids. Investing in mortgage notes can be a way to create that lasting impact.
Right, because if you have these notes, they can become assets that can be transferred down the line, giving your family a financial cushion.
Exactly. I had another client, let's call him Tom, who is really focused on wealth transfer. He started investing in notes with the intention of eventually gifting them to his children.
That's a smart move. It's like they're setting up a sort of financial safety net for them.
Yes. And, with the current economic trends, rising interest rates, shifting housing markets, having assets that can yield income is crucial.
It definitely is. And it's interesting because as these economic conditions change, people over 40 might feel more anxious about their financial stability.
Right, and that anxiety can lead to poor decision-making. But having a solid plan, like investing in notes, can really help alleviate that stress.
It gives you that sense of control, doesn't it? And it's about feeling secure in your financial future.
For sure. And then there's the emotional side. When you know you've made smart investments, it can really boost your confidence.
Exactly. It's like having that financial security allows people to focus on other aspects of their lives, like enjoying time with family or pursuing hobbies.
Yes. And that's what it's all about. Balancing your financial health with your personal happiness.
Well, and speaking of balance, the market is always shifting. If someone is looking to invest in mortgage notes, they need to do their homework.
Very true. You want to understand the market conditions, the borrowers, and the specific notes you're looking at.
Right. Like, a performing note is going to be different from a non-performing one. You need to assess risk versus reward carefully.
Absolutely. I've seen investors get excited about the potential returns, but overlook the due diligence part.
And that can be a real pitfall. especially for those who are newer to the game.
Exactly. But, once you get the hang of it, it can be incredibly rewarding.
Plus, with the right strategies, it's not as complex as it seems.
True. And for those over 40, it's a chance to diversify their portfolios and not put all their eggs in one basket.
Yeah, and diversification is key, especially as you approach retirement. It's about mitigating risks while still seeking growth.
Definitely. And with mortgage notes, you're often dealing with real estate, which historically appreciates over time.
And this can be a hedge against inflation too, right? Like, real estate tends to hold its value better compared to some other investments.
Exactly. So as we transition into some core strategies for getting started with mortgage notes, let's keep in mind how this fits into the bigger picture of financial security and wealth building. So let's dive into the core strategies when it comes to buying mortgage notes. I think a great starting point is understanding some basic rules of thumb that can really guide your decision making.
Absolutely, and one that often comes up is the 1% rule, right?
Exactly. The 1% rule suggests that the monthly rent you can expect from a property should be at least 1% of the purchase price. So if you're buying a property for, say, $200,000, you should aim for about $2,000 in monthly rent.
That makes sense. It gives you a quick way to gauge if a property is worth pursuing. But what if the property is in a market where rents are lower?
Good question. In those cases, you might have to adjust your expectations or look for properties that have more potential for value appreciation. You could also consider investing in areas that are on the rise, where you might see rent increases over time.
Right, so it's not just about the current numbers, but also the potential for growth. What about the 50% rule? I've heard about that one too.
The 50% rule is pretty straightforward. It states that you should estimate that about 50% of your rental income will go towards expenses, like maintenance, property management, taxes, and so on. So, if you're expecting $2,000 in rent, you'd budget $1,000 for expenses.
And that means the remaining $1,000 is your cash flow, right?
Exactly. And it's a good way to ensure you're not getting in over your head with costs. Always factor in those expenses early on.
Speaking of cash flow, how do you evaluate if a note is a good investment?
One effective way is to look at the yield. You can calculate the yield by taking the annual income from the note and dividing it by the purchase price. For example, if you buy a note for $100,000 that pays $8,000 a year, your yield is 8%.
That's a nice, clear formula. And I suppose the higher the yield, the better the investment.
Generally, yes, but also consider the risk associated with that yield. Sometimes higher yields come with higher risks, like properties in less stable markets or distressed notes.
Got it. So it's all about balancing potential returns with potential risks.
Exactly. Another thing to keep in mind is the cap rate, which stands for capitalization rate. It's a measure of the property's potential return on investment. You calculate it by taking the net operating income and dividing it by the property's value.
And how does that tie into buying mortgage notes?
Well, when you're evaluating the overall performance of a property tied to a note, understanding the cap rate can help you assess whether the property is fairly priced or not. For instance, if you know the market cap rate is around 7% and your property's cap rate is lower, you might want to reconsider your offer or look for ways to increase that income.
Makes sense. So if the cap rate is lower than the market rate, it could indicate that the property isn't performing as well as it could be.
Exactly. And that could also mean you might have to put in some work to improve it.
Speaking of improving properties, what types of properties are best for buying mortgage notes?
Single-family homes are often a solid choice because they tend to be in demand. But you can also look at multifamily properties or even commercial properties, depending on your risk tolerance and investment strategy.
So, like, a duplex could be a great option because you have multiple income streams?
Yes, exactly. A duplex offers the potential for 2 rental incomes, which can significantly increase your cash flow and reduce risk.
And how about the markets? How do you choose where to invest?
Well, it starts with doing your homework. Look for markets with job growth, population growth, and a balanced supply and demand for housing. A good indicator is also the rental vacancy rates. Lower rates often suggest a strong rental market.
That's such a good point. So you want to look for areas where people want to live and work, right?
Yes, and don't forget to factor in economic indicators, like the local unemployment rate. A strong job market often leads to increased demand for housing.
And what about financing options when buying mortgage notes?
Typically, you can use cash, but if you're looking to leverage your investment, you might consider conventional loans, private money lenders, or even seller financing in some cases.
Seller financing sounds interesting. Is that common?
It can be, especially with motivated sellers who are looking to close quickly. It allows for more flexibility in terms of terms and interest rates, which can be advantageous for both parties.
So let's summarize a bit. We've talked about rules of thumb, like the 1% rule and the 50% rule, ways to evaluate notes through yield and cap rates, and how to select the right properties and markets.
Yeah, and let's not forget the financing options that can help you get started. But, as with any investment, it's crucial to stay informed and perform thorough due diligence.
Absolutely. And with that in mind, what do you think are some common pitfalls people should be aware of when buying mortgage notes?
Sarah, one of the biggest pitfalls I see with investors, especially those new to buying mortgage notes, is over-leveraging. It's really easy to get caught up in the excitement of a potential deal and think, oh, I can stretch my budget a bit more. But that decision can come back to bite you.
Yeah, I can see how that would be tempting. What happens if someone over-leverages, though?
Well, let's say you buy a note for $100,000 and you finance it with a $90,000 loan. Now, if anything goes wrong, like the borrower defaults, you're left with a significant financial burden. You may end up in a position where you have to liquidate quickly, and that can lead to losses.
Right. And it's not just about the money you put in. It's about how much you're willing to risk, too.
Exactly. I remember a client who bought a note thinking it was a sure thing. They stretched themselves too thin, and when the market shifted, they couldn't keep up with the payments. It's important to have a buffer, a safety net, if you will.
So what's a good rule of thumb for avoiding that?
A good guideline is to aim for no more than 70% of the property's value in financing. This way, you have some wiggle room if things don't go as planned. And, don't forget to account for other expenses you might face.
That's a great point. Hitting costs can really sneak up on you, can't they?
For sure. A lot of investors overlook things like property taxes, insurance, maintenance costs, even management fees. I had a colleague who bought a note, and while the cash flow looked great on paper, he didn't factor in the property taxes that were several $1,000s higher than expected.
Oh no. That must have been a tough lesson to learn.
It was. He ended up having to raise the rent to cover those costs, which made it harder to keep tenants around. That brings me to another common mistake, not properly vetting tenants.
Yeah, I imagine that can really impact your cash flow.
Absolutely. If you end up with bad tenants, it can lead to missed payments, property damage, or even eviction processes, which are costly and time-consuming. I had another investor friend who was eager to fill his property and didn't do thorough background checks. He ended up with tenants who, let's just say, didn't treat the place very well.
That sounds frustrating. So what should investors look for when vetting tenants?
Well, it's important to check their credit history, rental history, and income verification. You want to get a clear picture of their reliability, and don't be afraid to ask for references. A good tenant will usually have no problem providing them.
Makes sense. I guess a little extra time up front can save a lot of headaches later.
Exactly. And another common mistake I see is ignoring cash flow. Some investors focus too much on appreciation potential and forget that positive cash flow is crucial for long-term sustainability.
Right, because if you're not bringing in income, you're really just sitting on a liability.
Exactly. I knew someone who invested in a property that was in a rapidly appreciating area. They thought they'd cash in big time later on, but the monthly expenses were way higher than expected, and they couldn't cover those costs while waiting for appreciation to kick in.
That's a tough spot to be in. So how can someone avoid that pitfall?
Always analyze the cash flow before making a buy. Look at all the income and expenses. A good rule is to aim for a cash flow that covers at least 1.25 times your total expenses. If the numbers don't add up, it might be time to walk away.
That's a solid strategy. Now what about timing the market? I've heard investors get burned by trying to time their purchases.
Oh, timing the market is one of the trickiest things in real estate. Investors often think they can predict when prices will go up or down. I had a client who waited for the perfect moment to buy a note, and of course, ended up missing out on fantastic opportunities.
So it's better to focus on your own financial strategy rather than trying to predict the market?
Exactly. Markets fluctuate, and trying to time them can lead to analysis paralysis. Instead, focus on finding good deals that fit your investment criteria. If you find a note that meets your goals, buy it.
That sounds much more practical.
And the last pitfall I want to touch on is not having a clear exit strategy. You really need to know what your plan is if things don't go as expected.
That's a good point. What kind of exit strategy should investors consider?
Well, having a plan for selling the note, refinancing, or even transitioning to another investment can make all the difference. It's about being prepared for any situation that may arise.
That makes a lot of sense. So, if someone spots any of these red flags early on, what's the best way to recover or avoid falling into those traps?
First, they need to be proactive. Regularly review their investments, keep an eye on market conditions, and always stay informed about the properties they own. If they see red flags, like declining cash flow or issues with tenants, they should address them immediately.
And, I guess, don't be afraid to consult experts or mentors when needed, right?
Absolutely. Surrounding yourself with knowledgeable people can provide invaluable insights and help you navigate challenges more effectively.
Such great advice, Mike. It's all about being informed, prepared, and flexible in this market.
Exactly. By learning from these common pitfalls and having a solid strategy, investors can build long-term wealth and avoid many headaches along the way. So let's dive into some immediate steps our listeners can take if they're interested in buying mortgage notes. Yeah?
Absolutely, Mike. I think the first thing they should consider is doing their homework. Knowledge really is power in this space.
Right. A great starting point is familiarizing yourself with terms and concepts. I'd recommend checking out a few resources like The Note Investor, Times by Jim Napier. It's a solid read for beginners.
Oh, that sounds good. And speaking of resources, there are also podcasts out there, like The Note Investor Show. It's informative and gives practical tips from folks who are in the trenches.
Exactly. And, there are some great online platforms where you can find mortgage notes. Websites like PaperStack and Notes Direct can be really useful for browsing available notes.
Yeah, and it's crucial to have a checklist when you're looking at potential notes. You want to consider things like the loan-to-value ratio, the borrower's credit score, and the property's location.
Oh, definitely. Also, using tools like Zillow can help you assess property values quickly. You can get a good idea of what similar properties in the area are going for.
Right, and if you're looking for cash flow analysis, the Bigger Pockets calculator is fantastic. It allows you to run the numbers and see if a note is a good fit for your financial goals.
And let's not forget about DealCheck. It's a great app for analyzing rental properties, but it can also be used for notes if you want to see how they fit into your overall portfolio.
That's a smart way to look at it. And if you're just starting out, how about setting a manageable goal? Like, analyze one deal per week?
Yeah, that's a great habit to build. Even if it's just a simple analysis, it gets you in the rhythm of thinking like an investor.
And connecting with others is so important too. Joining a local real estate meetup can provide you with insights from more experienced investors and even potential partnerships.
Absolutely. Networking can open up many doors, and you might find mentors who can guide you. Plus, sharing experiences can be really motivating, right?
Exactly. Another thing to consider is accessing your local MLS. It can provide a treasure trove of data about properties and notes in your area.
For sure. And don't forget to look into Rentometer. It's a handy tool for checking rental rates in specific neighborhoods, which can help you gauge potential cash flow.
So we've got books, podcasts, checklists, and tools. What about forming some habits? Anything else to suggest?
Well, I think starting small is key. Maybe set aside just 30 minutes a week to review notes or properties. It's amazing how much you can learn in just that little time.
Yeah, and consistency is so important. Over time, those small efforts add up, and before you know it, you'll be much more confident in your decision-making.
And, keep a journal of what you learn It helps solidify your understanding and gives you something to refer back to later.
That's a great tip. Reflecting on your progress can really boost your motivation. Plus, it's a good way to track what strategies are working for you.
Definitely. And as you get more comfortable, you might even want to explore note investing groups online. They can provide valuable support and resources.
Oh, that's a great idea. Engaging with a community can help you stay accountable and inspired.
So, those are some practical first steps. Now let's bring this all together. Well, Sarah, it's been quite a journey discussing real estate notes today.
Absolutely, Mike. So many valuable insights packed into this episode. I think listeners can really take away a few key points.
Yeah, like, first off, understanding what mortgage notes are, that's crucial. It's not just about owning property, but also owning the debt on that property.
Right. And then there's the potential for passive income. When you buy a note, you can earn money without the responsibilities of being a landlord.
Exactly. Plus, the flexibility in investment strategies. You can buy notes at a discount or even negotiate terms that suit your financial goals.
And let's not forget about due diligence. Doing your homework on the borrower and the property is key to minimizing risks.
For sure. And it's really about creating opportunities for yourself, right? Building wealth isn't just about having a lot of money. It's about making smart choices with what you have.
Yeah, and it's never too late to start. Even if you're over 40, there's so much potential in real estate investing. It's all about taking that first step.
So true. And for those listening, if you found this episode helpful, we'd love for you to like, subscribe, and maybe drop a comment sharing your biggest takeaway or any questions you have.
And don't forget to share this with someone over 40 who's looking to dive into property investing. It could be just what they need to get started.
Absolutely. And next time, we're going to explore tax lien and deed investing, a whole new way to build wealth.
I can't wait for that discussion.
Me neither. Thanks for tuning in today. And remember, every step you take in real estate is a step towards financial freedom.
Bye for now, everyone.
Take care.